Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at Nvidia. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the technical and the fundamentals analysis of the stock, but we also talk about finance and investing. And if you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. Thank you so much. Now let's get started. As I mentioned, we are going to take a look at Nvidia, and if we go down to the screen, we can tell that the Nvidia is traded on the Nasdaq and are in the manufacturing sector, and their market capitalization is at $560 billion and their revenue is at $21.9 billion. The PE ratio is at 80. Now guys, you know me that I like to take a look at companies with a PE ratio of 20 or below. Having a PE ratio of 80, that is just way too high. But this also indicates that the market has high expectation of the company. And if the company doesn't meet those expectations, we will see the price fall. So there's a huge risk over here. But a PE ratio of 80, that is just a no for me. Their profit margin is at 32%. I like this one. Normally, I like to take a look at companies with a profit margin of 15% or higher. So having 32% in profit margin, I like that. So that is a major go. Price to sales ratio is at 25.9. That is just way too high. Normally, I like to take a look at companies with a price to sales ratio of maximum 2. So having a 25.9, just way too high, so that is a no for me. And their price to book value is at 26. This is just way too high. I like to take a look at company with a price to book value of maximum 3. So having 26, that is just way too high, so that is a no for me. And if we summarize, the price to earning is way too high, the price to sales ratio is way too high, and the price to book value is just way too high, indicating that the company is just overvalued and we need to see the price fall in order for it to become more attractive. Now they pay out a dividend of 16 cents. I like dividend income, so that is a plus. I like that. Effective return 0.07%. Let's not just talk about it. It's just way too low. So that is a no for me. And the return on equity is at 40%. I like this one. A return on equity basically tells you as an investor a company's ability to create a return on the invested equity. And for an investor, we need to know if the company is able to create a return on the capital that we invest in them. So having 40% return on equity, I like this one. So that is a major go. And the return on assets is at 14%. I like this one. So 40%, I'm loving it. So that is a way to go. Now, the stock is currently traded at $224 per share. And if we look at the 50-day moving average, we're trading way above it, but also way above the 200-day moving average. This is a clear signal that we might see the price move even higher. And if we glance just quickly on the chart, we can see that we have been moving higher, and currently right now just right at the resistance level. So if we are to trust the indicator, then we might see price move up to the resistance line here. And we also need to be cautious, because if there's a lot of seller that comes in and push the price higher, and we just need to be cautious over here. But we are going to take a closer look at the technical analysis of the stock further down. But let's move over to the income statement. And what we can tell by the look of an income statement is that the total revenue went from $6.9 billion in 2017 up to $16.5 billion in 2020, and has been growing steadily every year with we fell off 1 year, but overall we are moving in the right direction. I like this one. Gross profit went from $4.1 billion up to $10.4 billion, and also has been growing. As we saw earlier, we fell off 1 year, but overall we're in the right direction. I like this one. Net income went from $1.7 billion up to $4.3 billion, and it has been growing steadily. And the trend, as we can tell, we fell off 1 year, but overall we're in the right direction. I'm loving this one. I like what I'm seeing right here. Now let's continue to the balance sheet. And what we are interested here in the balance sheet is the current assets versus the current liabilities. And we can see there's a huge difference between the current liabilities and the current current assets versus the current liabilities. Basically, if the company were to convert the current assets to cash, they're able to pay off the current liabilities, but also able to pay off the total liabilities, and that is a huge, and still be able to have $4 billion left. So that is great. I like that one. Imagine being able to pay off your house loan, your car loan, your student loan, everything, and still have cash laying around. I like this one. So the total liabilities went from $4 billion, went down to 3.8, but got back up to $4 billion and has been growing steadily every year. That is a minus. I would like to see the company reduce their total liabilities. Their outstanding shares went from $585 million up to 620 million outstanding shares, and has been growing steadily every year, and that is a minus. Basically, what it tells you as an investor, the more outstanding shares you see, the fewer your share of the company is decreasing. And outstanding share is the way for a company to bring in capital. So, for instance, a lot of investors miss this one because they've been looking only on how much the debt has been growing over the past few years, now looking at the outstanding shares, because a lot of company may not bring in a lot of debt, but the outstanding share has been growing rapidly. So seeing that they are increasing the outstanding shares, that is a minus. So now let's move over to the cash flow, and what we are interested here is the operating cash flow versus the capital expenditure. And we can see that the operating cash flow went from $1.7 billion up to $5.8 billion and has been growing steadily every year. I like that. And the last year, 2021, we saw a difference between the operating cash flow and the capital expenditure of $4.7 billion. That is great. I like that one. And we can also see the development over the last few years. It has been going in the right direction. A major plus. I like this one. Now let's move over to the key figures, and what we are looking here at. The earnings per share went from $2.8 per share up to $6.9 per share, and has been growing every year, but we fell off 1 year, but overall we are in the right direction. I like this one. Revenue per share went from $11.8 per share up to $26.6 per share, and also been growing steadily every year, and the trend is the same. We fell off 1 year, but overall I'm liking what I'm seeing here. Equity per share went from $9.8 per share up to $27 per share, also growing steadily every year. I like this. Now dividend, they paid out $0.5 per share, or 45 cents per share, 2017, and went up to 64 cents per share, and it has been growing, and the dividend payout has been growing every year. I like this. I like the income. Now the dividend share went from 15.6% and down to 9%, and has been falling. A few years we fell off, but overall, and in 2020 we got back up, but overall they reduced their dividend share. I like this one. I like to take a look at company that pays out less than 60% of the profit, because I want the company, I want some of the capital to remain in the company for them to reinvest, become more efficient, and so on. So I'm liking what I'm seeing. So this is a major plus. Now the profitability, the gross margin went from 58.8% in 2017 up to 63% and has been growing steadily every year. I like this. So it tells you as investors that the company is becoming more and more efficient. So that is a major plus. And the total cost of goods sold is decreasing. So that is a plus. I like this one. Their operating margin went from 27% up to 26%. Down to 26%, and we went up. We improved a few years, but then we have seen lower and lower numbers. So, but overall, I'm liking what I'm seeing here. So that is a plus. But still, I would love for them to reduce their operating costs. So if they can reduce the operating costs, that would be a major plus. But overall, I'm liking what I'm seeing here. The profit margin went from 24%. Up to 26%, and we got up, increased a couple of years, but then as we saw previously, we started to see a lower number. But overall, I'm liking what I'm seeing here. I like companies that has a profit margin of 15% or higher. So having a 26%, that is a plus. I like this. Return on equity went from 28.9% down to 25.6%. We got up a couple of years, but overall, then we saw a lower number. So even though the number is still high, this is a minus. I want them to improve the return on equity. Return on equity, as I mentioned before, basically tells you as an investor the company's ability to create return on the invested capital. So seeing a lower number, that means the company is no longer as able to create a return on the capital you invested in them. So that is a minus. Return on assets went from 16.9% down to 15%, and we improved a couple of years, but overall, and then we fell off. That is a minus. Solidity went from 58%, 0.5% up to 58.6%. We improved a couple of years, but the last year we fell off. So this is still a plus because the overall trend is positive. Just 1 year, that's not a huge, but overall trend is positive. Solidity basically tells you as investors how much of the assets is financed by the equity, but it also tells us about the company's financial strength for the short term. And having seen that the numbers are improving, that is great. I like this. Balance sheet liquidity went from 16 up down to 1.7, and we have seen lower and lower numbers here, so that is a minus. Balance sheet liquidity as solidity, but here it looks at the company's financial strength for the long term, as we can see that their ability to sustain for the during a more risky period or in more when the economy is not doing so well. The risk is higher because their ability to sustain the business is lower. So that is a minus. Debt ratio went from 0.7 and has remained the number. We reduced the debt ratio a couple of years, but now we are back on what we had 5 years ago. So that is a minus. Basically, what debt ratio tells us is that the 2021 we had 0.7 times more debt than equity in the company. So that is a minus, even though it's not a huge number, but the overall trend it tells us that we're back where we started. So that is a minus. So we have gone through the income statement, the balance sheet, the cash flow, the key figures. Now over to the key feature of our software, which is the pillars. Basically what the pillars is, it gives you a simple, holistic overview of the company's performance in just one a slide, one picture. It saves you time. So basically what we have gone through so far, it gives you everything in one picture. So if we summarize here, we can see that the PE ratio is above 20, which is a minus. They pays out dividends, which is a plus, and the dividend payout share is less than 60%, which is a plus. Dividend increased over the past 5 years, a plus, and the numbers of outstanding shares have increased, which is a minus. Revenue increased over the past 5 years, plus, that is a positive. Profit margin above 15%, it's positive, and profit increased over the past 5 years as a positive, and current assets is greater than current liabilities, and that is a positive. Solidity increased over the past 5 years, positive, and balance sheet liquidity decreased over the past 5 years, that is a minus, and debt equity ratio increased over the past 5 years, a minus, and the total liability have increased over the past 5 years, minus. Guys, as you can tell, it gives you a simple, easy to digest overview of the company's performance, and you can have this tool for only $25 per month, inclusive everything we've gone through, plus you get access to our page where we publish more articles and videos for you to consume and enjoy, and also access to our chat where you'll be able to chat with me alongside with other members. So for only $25, it's yours to have. Jump on today and let's get started. Now let's go over to the technical analysis of the stock. So here we have the stock. Let me just lay down the support line over here. Let me change the color to green, and let me lay down the resistance line, something like that. Let me change the color to red, and let me see here, we have a line here, something like that. Let me change the color. Okay, as we can tell here that we are trending in a positive direction. We are seeing higher lows and higher highs, which tells us that we are in a positive trend channel. And as we saw before, is that the price is trading way above the 50 and the 200-day moving average, which is a clear signal that we might see price move even higher. Now what I would do is I would be very cautious here. As we can see that we just broke the resistance level here and pushed higher, and then came back down and touched what used to be a resistance level, a resistance line, which is now a support line, and now it seems like the price tries to break even higher. Now, I would be very cautious here, even though if we are to trust the indicators, it tells us that we might see price break higher, and if it would break the previous high, that would indicate for me that there is a buy here. So that is what I would do, but also be very cautious. There's not a lot of margin of error here, so basically what I would do is wait for the price to push higher above the previous high, and which would indicate it's a buy, and then I would jump in and trade for higher levels. But different scenarios would be if the price came down and broke back to the channel and back to this support line, because we can see here that we've been here on this support line before, like here, and here. It's an indication that this support line holds. So if the price would break down to this levels, this is where I would also enter the trade. And if we would enter the trade, we could see a price move of 20%, which is not huge, but it's not bad. A 20% price move, it's okay. But the dream scenario would be to enter the trade below this support line, because I believe there is a lot of buyers that are waiting for the price to enter this area in order to get in. Because if the price would drop down to this support level, and you enter here, and the buyers come back and push the price even higher, then we might see a price move of 40%. Now that is a trade we would like to do, but 20%, that is not bad. So to summarize, be very cautious. That's what I would be, very cautious here, because there's not a lot of margin for error. So I would wait for the price to enter, to push even higher, and if it breaks the previous high, then I would enter the trade. Otherwise, I would wait for the price to get back down into the channel and to the first support line and enter there. But if we would see the price break down below that, then that is a strong buy, and that's what I would love to do, a trade below this support line in order to trade even higher, to push the price even higher. So that is what I'm looking at, and that's how I would trade the stock. How would you trade the stock? Please let me know in the comment box below. And guys, this is it for this episode. I truly hope you enjoyed this one. Please give me a thumbs up, comment, subscribe, and let me know what you think and how you would trade the stock, but also what stocks you want me to take a look at. Thank you once again for watching. Until next time, take care guys. Bye bye.